Okay, well, Jeffrey Dennis is with us, independent emerging markets commentator. Jeffrey, good to have you with us here. Thank you very much for your time. Prashant this side. So a little better overnight, but it's not really helped. U.S. markets going up or going down hasn't really mattered since that top in September for India, where there has been continuous FII selling. The intensity is coming off, though. And many are starting to say, and we spoke to a bunch yesterday, who are saying that maybe it's time to, get back into the market here. Your thoughts, Jeffrey?
I think it probably is in the short term a good time to think about getting back into the market. I mean, the way I'm looking at the overall situation here is that obviously you've seen a tremendous rally in the US and a poor performance by emerging markets since the presidential election on November the 5th. And that's because investors are pricing in now higher bond yields, a stronger dollar, etc., possibly a slower rate of decline of Fed interest rates. So what that does is it tends to suck money out of the emerging markets. And my LinkedIn posts recently have really changed their tune, and I'm much more cautious about EM now in this environment because the Trump trade, so to speak, assuming it goes further, we'll have to see, isn't just not favorable when you get those sorts of conditions. Now, India is always going to be vulnerable when you get this sort of situation because it's so highly priced, and it so was obviously a few weeks ago so highly regarded by investors. But now that you've seen it coming off considerably, and I do really still believe in the growth story in India. I think if you get a stabilization for a period of time in some of these key overseas variables, such as bonds and such as the dollar, I think you will see India beginning to make some sort of a modest recovery. But don't let me muddy the waters here. This is a much more challenging environment, I think, for EM following President Trump's election, I guess about 2 weeks ago now.
So what would your allocation then be, or how would that shift in DMs versus EMs? And if you could, talk about your pecking order in emerging markets itself.
I do think it, obviously we have to see how this whole Trump thing plays out. And the key issues, as your viewers will know and you know, are how much does he increase tariffs? And how much do other countries retaliate? What is the impact on all of this going to be, including tax cuts on the US fiscal deficit? So for me, the key is to watch the bond market in the US, because what the bond market is going to signal is concern about the deficit and therefore the debt levels. And I think bond yields are probably going quite a bit higher over the next, let's say, 12 to 18 months, maybe no more than 5%, but enough, I think, to propose some sort of challenge to the emerging markets, indeed to equities maybe generally. At this point, I would tend to prefer at the margin the developed markets to the emerging markets, but I still think it's worth pointing out that within EM, you've seen some very good gains year to date, although India's pulled back recently in India, more recently in China, also in Taiwan, also in places like South Africa. So where I am is to tentatively take a look back at take a look again at India in the short term for an overdue. I think still be long Taiwan because I think tech continues to look good selectively in other emerging markets such as in the ASEAN region, and it may be time to start taking a look at some of the oversold Latin American markets as well. But mark my words, I think this is a much more complicated environment now for EM because of Trump's election.
Hi, Jeffrey. Good morning. The last time we chatted, we were trying to factor in Trump coming into power, and that's precisely the way it played out. And you had mentioned in the past, India over China and Brazil over Mexico. That's your preference. But, you hinted that maybe the yields could head towards 5%. Well, I'll tell you what, a lot of our viewers will be hoping not, because that will not be very good news for emerging markets. What are you pricing in with regard to the Fed? Another rate cut coming in the next meeting, point number one. Point number two, what about the dollar index? That moved to around 107 and it moved very quickly.
Yeah, forgive me, sorry. I do think, of course, the other things that will influence the Fed are the inflation numbers appear to have stalled out at about the 2.5% level for the headline, just over 3 for core. I think they'll come down a bit more, but it's going to be slow going from here. The US economy looks pretty good. Now, I think what that probably means is the Fed cuts in December. And as of this moment, I think the prospect of 4 rate cuts next year, which is what the dot plot says, 4 rate cuts in the US is very, very unlikely. And I think it's more likely to be something like 2. And if it's not 2, it could be less than that. So I think, and again, inflation obviously is going to be impacted by these tariff increases. So you've got to see how that all plays out. So as far as I'm concerned, as I say, this is a challenging environment, and I think what it does mean, and you've just said it there yourself, is that the dollar is going to continue to be well bid, and that's completely against my long-term view just a few weeks ago that the dollar would weaken. And if the dollar continues to be well bid, European economies are weak. I think we possibly challenge parity against the euro. That is not good for emerging markets overall, and I think. This is, as I say, it's a more challenging environment than I thought was the case several weeks ago.
All right, Jeffrey, we'll leave it there. Thank you very much. And I think you made that point clear. Absolutely. Appreciate you joining us here on CNBC TV 18, as always.